Now, near the money is fairly simple. Near the money is essentially when it's really close to the actual stock price. So anything that's basically that you see here, anything that's between 38.50 and 42.50 is in the yellow, it's in the money. That just means that it's worth something. The other ones below here aren't so much. That's for the week there. If you go down to the next week, you can see that some of these are in the money. Anything that's between 38.50 and 42 again is in the money. And then you go on to the next week and so forth. Same idea. 38.50 to 42.50 is in the money. The rest aren't. And if you'll notice something else here, you have a high volume. The bid. If you notice the bid pricing, there's no bids on the ones that are out of the money. There's a high bid on some of these that are really close. Like for example, 39 has got a lot of value to it. However, there's only 7 cents on bid on the 42.50 because it's so close to the actual price of the stock. So the further away you are, the more interest they generally have. In some cases it doesn't quite work out that way. It just depends on what they think the value is going to be. But in this case, for example, you have a bid and a last price. The bid and the last price, as we discussed before, is the price that they're willing to pay versus the price that they're asking for. And the bid price here is like $3.10. The last price that they asked for is $5.10. That's essentially the range that they're looking for that particular one, because it's worth so much money, because it's far away from the actual stock price. The same idea with all the other ones. The further away it is, generally speaking, from the stock price, the more money you'll have that's available, and therefore the higher price it is. That's the calls for in the money, near the money, and out of the money. Let's talk about some of the put option examples. Okay, so let's go to a put option in